Hi folks, welcome back to the channel. In this video today, we're going to be talking about the company called Social Finance, also known as Sofi. We're going to be talking about their technology platform, the services they offer, their plans to go public, and what I think is a very bright future for this company ahead. If you've never been to my channel before, my name is Jason. I'm a certified financial planner and a giant nerd with a wide array of interests. I'd really appreciate an early thumbs up. That does help with the almighty YouTube algorithm. And if you like my content, please don't forget to subscribe. Also, I'm on Patreon. If you'd like to support my channel that way, you can check out the link in the description and engage with a great community of investors. And of course, I have the ubiquitous WEBULL link also in the description, but that's all I'm going to say about that for right now. Now, if you watch my channel regularly, you know that I've been meaning to do a video on Sofi for quite some time, and I wanted to get a video out before they merged with the Chamath Palihapitiya SPAC. But with the window rapidly closing here on the merger, I decided to go ahead and just make the video, disclose the fact that I hold a significant, or at least significant amount of shares for me, a long position in IPOE. That makes me somewhat less than unbiased here. Even more so because a lot of the information in this video is sourced from the Sofi investor call deck that the company published just recently. So I'm going to bottom line it here for you pretty early in this video. I do think that over the long term, this stock is going to do quite well. I actually think that, in fact, over time, they're going to be one of the strongest players that emerges from the fintech revolution, with market power and cultural significance on the same level as other fintech disruptors like PayPal, Square, and Robinhood. The fintech revolution isn't going to be some sort of winner-take-all type of French revolution in the financial industry with all of the companies that are losers going to the guillotine. It's probably going to be more of a winner-take-most type of situation or opportunity for companies like Sofi that are focused on a client base of high earners that are not well served. That's actually a pretty important phrase for Sofi. That phrase, high earners not well served, is pretty often repeated in all of the literature they provide to investors and in Sofi investor presentations, and for a good reason. It's serving this market of folks that's going to make Sofi one of the companies that's going to disrupt banking and financial services. So what is Sofi? Sofi's mission statement is pretty simple, folks. Sofi's mission is to help people reach financial independence and realize their ambitions. Also, according to Sofi, financial independence doesn't just mean being rich. It means getting to a point where your money works for the life you want to live. Sofi is a fast-growing, technology-driven personal finance company that offers a wide range of financial products directly through its app and its website. The company operates in three segments: lending, the technology platform, and financial services. This has resulted in a diversification of revenue, growth rates, interest rate risk, and geographic risk. The lending segment of their business right now is actually the biggest slice of their revenues, accounting for almost 83%. Sofi was actually founded in 2011 by 4 Stanford graduates who wanted to come up with a way to provide more affordable lending options for those who had to take on debt in order to finance their education. They ended up leaning pretty heavily on their relationships with Stanford alumni to get started. They managed to find about 40 alumni to invest an average of around $20,000 each to fund loans for around 100 students at Stanford for a pilot program. This pilot program was very successful. Today they offer just about every kind of lending you can think of, including student loan, refi, personal loans, mortgage, in-school loans, you name it. Very importantly, the lending arm of this business is already profitable. It has projected compound annual growth rate of 25% over the next 5 years and has very healthy profit margins of 58%. The technology platform of Sofi's business really came into its own with the acquisition of Galileo Financial Technologies. This is a company that specializes in providing financial services APIs. If you don't know what an API is, think of it this way. It's a fintech backbone for companies that want to have a technology platform for offering credit cards, debit cards, bank accounts, bill payments, and other financial services. It's all of the programming that connects the app on your phone to the world of banking and finance, and it's behind many of the popular services offered by companies like Remitly, Chime, Robinhood, Monzo, Varo, TransferWise, and Revolut. And because I'm making this video on Pi Day, I should say that Galileo Technologies has its fingers in a lot of pies. And yes, I like pie, folks. The acquisition of Galileo Technologies was, of course, a big signal that Sofi planned to get into banking in a major way. Sofi applied for a bank charter in Q3 of 2020 and recently made a move that's going to speed up the process of getting the bank charter approved. They announced the acquisition of a regional bank in California called Golden Pacific Bancorp. While the acquisition is really pretty small in terms of corporate numbers, only about 22.3 million, it changes the way SoFi's application for a bank charter is going to be handled and possibly speeds up the process greatly. Now, this is probably a far more important move than it appears on the surface, and I'll probably get into that in a later video. But for right now, possible business from chartered bank operations is not even included in their profitability projections and are not included in the technology platform arm of the business anchored by Galileo Financial Technologies. Despite that, the technology platform arm of the business is also already profitable and growing quickly. The compound annual growth rate of Galileo's operations is 55%, and profit margins are already a healthy 62%. The third segment of the business that SoFi operates is financial services, which is the most diverse and by far the least mature segment of their operations, and is the only segment that's not profitable at this time. Through their financial services arm, SoFi invests with services like crypto, stock trading, active investing, automated investing, ETFs, and more. They offer SoFi Protect, which is insurance products like renter's insurance, homeowner's insurance, auto insurance, life insurance, and even estate planning. They also offer online cash management services like SoFi Credit, SoFi Money, and SoFi Relay, and they have a burgeoning business in company management and benefits with SoFi at Work. As I mentioned, though, this segment of the SoFi empire isn't profitable yet, but in 2020, growth was insane, and projected compound annual growth rate for this segment is estimated to be somewhere around 153% annually for the next 4 years. So at this point, you probably have a better understanding of the breadth of the operations of SoFi than you did at the beginning of this video. Now, I know that before I really started looking into this company, I didn't really understand the scale of what they'd already achieved. I started looking into them after they acquired Galileo Financial Technologies, and I've been chomping at the bit for them to go public for some time now. At this point in the video, you might be asking yourself, why am I so optimistic about this company in comparison to its peers, especially when I'm normally kind of a no hype, no frills kind of guy when I present my videos, right? So there's a couple of things that aren't all that obvious if you aren't familiar with the financial industry that make this a very attractive company to invest in, and I'll explain why those are important. But one of them, folks, is just dead obvious. As far as SPACs goes, this is really as good as it gets in terms of the financial health of the company. SoFi expects to be barely profitable by the end of 2021 and to have healthy and growing profits by 2020 and beyond. This really shouldn't be unique when it comes to a company going public in 2021 or 2022, but actually it is. A vast majority of companies going public via SPAC in the last 12 months have no revenues to speak of. They don't even have a product on the market, and profitability is either years away or a pipe dream that's never going to happen. I predict that almost all companies that manufacture something and that have gone public via SPAC in 2020, and most of the ones that manufacture something and are going public via SPAC in 2021, will either fail or be acquired for pennies on the dollar sometime within the next 7 years. Companies in the fintech space that aren't manufacturing anything and are going public via SPAC will actually fare better as their challenges are just simply different. Most of them already have products on the market and a path to profitability. So this reason is pretty obvious. Now, what are some of the reasons that aren't obvious? As I stated before, the fintech revolution is going to be a winner takes the most type of opportunity with around 500 million financial accounts up for grabs all across the nation. SoFi's customer focus is on highly educated young professionals, aged 23 plus to 45 with incomes in the $100,000 plus range. And this high earner, not well served demographic is actually larger than one might suppose, and a lot of wealth is wielded by this bunch and they aren't getting what they want. Traditional banks and financial institutions know this, that there's a lot of customer dissatisfaction. They know they're not serving their clients well, and they're doing exactly the wrong thing to solve what they see as a problem. If you've ever worked in the financial industry, or in particular at a bank, some of what I say next, you will probably certainly have heard in some sort of management meeting at some point from some manager you didn't really like. Instead of coming up with solutions to provide services that fill the needs for a younger, more agile, and less brand loyal population, banks have come up with a whole host of strategies to make their relationships more sticky. Because they know the way to get you to keep your funds in their bank is to have you engaged across multiple lines of business, so it's just too much of a hassle to switch banks. If you have a bank account, a savings account, a line of credit, or maybe a mortgage, you'll probably never leave that bank if you're an older person. It was never a good strategy for the customer. It was always a good strategy for the bank. It was always a strategy that depended on negative reinforcement as a method of keeping clients. For example, if you don't maintain a checking account and keep a certain balance in your savings account and possibly even a CD or a line of credit, you might be charged fees on your checking account or other accounts. Recent studies show that this trend is breaking down, and it appears to be breaking down faster for millennials. Take a look at this pie chart here. The top 10 legacy banks now only hold about 50% of all bank accounts, and 48% of folks bank elsewhere. But the real story here is the second pie chart. Despite all of the efforts to make client relationships sticky and to coerce you into bank loyalty, 50% of all Americans use more than one bank. I do it, you probably do it, and your reasons might be different than mine. But the real reason is probably that your bank just can't provide everything you need with flexibility and convenience and low fees. Legacy banks simply don't have an integrated one-stop solution on one digital platform. SoFi is pretty close to being able to provide all of that, especially with the preliminary approval of their bank charter. This has been what has been driving their growth, which has been seriously impressive, but was only accelerated by the events of 2020 and early 2021, like the pandemic, of course, and the GameStop phenomenon. But what is really impressive is the organic growth of multi-product members, those sticky relationships that make it much less likely that a customer is just going to pick up and leave when they're momentarily dissatisfied. While total product growth was 77% year over year, multi-product customer growth had a compound annual growth rate of 95%. Now over 775,000 of the 3 million members are multi-product members, which puts them on par with statistics from major banks at this point. One of the major reasons that you want these multi-product members is because of basic unit economics. The cost of acquiring a new customer is a lot higher than selling a product to an existing customer. This, coupled with the lower costs from vertical integration of financial products and services, leads to those fantastic margins that we discussed earlier, which are much, much higher than traditional banks. This is leading to some extremely high profit customer relationships with SoFi. 65% of their home loans came from existing members. In Q3 of 2020 alone, $30 million in loan revenue was driven by cross-buying from existing members, with only $1 million spent in acquisition marketing. I only wish that I had that kind of dollar-for-dollar return when it comes to the marketing that I do for my businesses. The low-cost profit drivers for SoFi don't just end with home loans either. Remember that loans right now account for 83% of their revenues. There's a lot of room to grow these other segments of the business. With the financial technology and financial service segments rapidly growing, SoFi is going to have a lot more opportunities to expose their existing clients to other solutions that they may have. In addition, SoFi will ostensibly be able to push SoFi product solutions across Galileo Technologies' fintech API to other fintech companies. This is something they've discussed in investor calls. I'm not sure what that looks like, but I'm really excited to see it. So yeah, folks, I'm pretty optimistic about the future of SoFi. They have a solid suite of products, a fine business strategy, and a plan to go on an acquisition spree after they go public to add to the functionality of their app and to diversify their revenue streams. They have pretty forward-looking management, actual revenues, and a real path to profitability within a year. So folks, I left a lot of things out of this video concerning features and services that SoFi offers. Look, it's just a YouTube video, folks. I can't hope to do justice to every part of their business in 20 minutes or less, so I hope you forgive that. So I was also not very critical of SoFi like I am normally when I talk about a company, and I'm sure that that has to be reflective of my bias when it comes to this company. I've been a fan of them for almost a year now, and I've been waiting for the opportunity to invest in what I think is going to be one of the most popular players and most powerful players in the fintech space. Now, if you have reason to think that I'm wrong or would like to point out where my enthusiasm is misplaced, please don't hesitate to let me know how wrong you think I am in the comments below. And folks, please don't forget to check out my Patreon link below if you get a chance and to subscribe to my channel. Thanks, and I'll see you next time.